Hi everyone, welcome to the 4Q 2025 update for Fundmanagerzech, which is me. So I'm going to go through the usual bits and pieces of the presentation, and we're going to do something a little bit different. As you know, we brought on a new analyst to help manage the portfolio, and his name is Bryson, so he'll be presenting on the performance. We're a little bit out of sync in terms of the dates because I was traveling for the Popular Investor Conference, and it was a fantastic time. I'll tell you all guys all about it next time. But it was a good time, and yeah, I think we just didn't sync up the times, and I wanted to do it during the conference, but I overestimated my energy levels, which weren't great during the conference, unfortunately. Travel and all that just made me a bit tired. So anyway, I'll just jump straight into it. So for any of you guys who are new here, I usually just kind of present a little bit about investment objectives, especially over the last quarter. I think we got quite a few new copyists joining us in the ranks. So I'll just like go through investment objective, the process of how we do it, a little bit of who I am, before we touch on the performance recap of 2025, which Bryson will go through, and then we'll go through the 4Q 2025 outlook. Okay, so here are the slides. Okay. Also, before we begin, just do remember that none of this is financial advice. Do consult a investment professional if you need it, and this is not marketing and or solicitation to buy any financial instruments. And of course, past performance doesn't reflect future performance. Okay. Okay, so the investment objective of the eToro portfolio is really because when my dad passed away, we couldn't find any good advice, or people were trying to sell us a lot of things. So yeah, that's one of the things my dad asked me to help him do, is just help manage the portfolio for my mom. And this was many, many years ago while I was still working in the bank. And even though I was in the bank, I knew that, there are ways of investing money that's a little bit more sophisticated, but it's very hard to access unless you have a lot of money. And also a lot of people are selling you for fees. So they just want to sell you high expensive products for the commissions. And very often they would bend the truth to get you to do the sale. And these are like nice people, right? But it's just the way that the game is structured, or the way the industry is structured, is more for commissions and things like that. So for regular investors, it was really unfair, and I didn't like the way that it was structured. So eToro is the perfect solution for me. They you access eToro, and anyone can access it. We as popular investors have to put our own capital into the eToro system. So we can't just like, invest with $500 while we manage millions of dollars. It doesn't work that way. We have to put our own capital in the game. And for myself, I put about 95% of whatever's liquid in my portfolio into eToro so that I can invest alongside you. If I lose money or you lose money, I feel it as well because I lose money. And I love that concept of skin in the game. And we are completely truthful on eToro because we cannot lie about our stats. If we lose money, we cannot pretend that we did make money. And yeah, eToro is just this really good solution to address the problems in finance. And that's why I do it and so passionate about it. But yeah, markets are a little bit crazy. Like, I just wanted to share this little tidbit. This is actually just from yesterday. So there was this 3Q EPS for ACM Research, which is one of the portfolio companies that we have. And the earnings announced, it says it fell short of the earnings per share, but revenue increased by 32%, which is good. So earnings per share is, it's bad. Revenue increase is a lot, so that's really good. As you can see, the stock fell 19.56%, so massive sell-off in the pre-market trading, or, after the announcement. Full year revenue remained the same, so there was no change there. And net income decreased from a year ago, but again, guidance is still the same. So I want you to look at both of these tickers that we have on the right. One is ACM Research Shanghai, one is ACM Research, which is based in the US. As you can see, true to the article that we mentioned, 19% drop. But in the Shanghai market, so the exact same stock, roughly speaking, because one's a whole co and there's a little bit of complexities to that, but roughly speaking, they're the same company. And China, when it opened, it was plus 1%, and US was minus 19. So this is kind of bizarreness of the markets that we live in. And, even though we're proud of how we've performed this year, it's just a reminder that, markets can be crazy. All the things that you expect, like, okay, earnings per share, or sorry, revenue growth has been insane. 32% is insane revenue growth. But at the same time, two markets, same stock, interpreted like completely differently. That's just how the markets are, guys. So yeah, we're proud of the performance that we've achieved so far, but do remember, like, in the past, I believe 2 weeks, or 2 months actually, the performance of the portfolio has been a little bit mixed. I'm not very happy about it because there are drawdowns, but at the same time, our investment process has remained really solid, and I am, you know, happy with what we've done. We just need to wait for the market to kind of turn in our favor, I guess. Not really turn in our favor, just keep our processes right and wait for the market to agree. Okay. Also, I wanted to share this post. This is on eToro, the Popular Investor Program. I have achieved 10 years on eToro. So yeah, great milestone. I actually got a cert somewhere over there that, celebrated my 10 years in Cyprus, where we had our Popular Investor Conference. So yeah, very happy to be 10 years on eToro. Okay, so just a little bit of our investment process and how we think about trades and, you know, how we manage a portfolio. So our philosophy when it comes to how we invest is we look for places where there is inefficient allocation of capital. What I mean by that is there is growth that's unseen by the market, or there's value unseen by the market, and we place it there. And if it's obvious, obviously we try and put more and we do our research and all that. So our job is to exploit the inefficiencies, no matter like how which strategy they form. That's why we're multi-asset. And it's just trying to find those little pockets of value. How we do it, we use quantitative models, we use screeners, and we have some subscription services to identify these signals. And we build our investment thesis based on like data and fundamentals. Okay. So after that, what we do is we confirm our ideas through backtesting. This is especially true for like currency trades, to ensure that they hold up. For different equities and cryptos where it's not relevant, of course, we don't do it. But in terms of currencies, that's always relevant. Idea selection, we always try and find the highest conviction opportunities. We try and, like, if they're smaller, less interesting opportunities, maybe we have like 1-2%. But the highest conviction ones, we place a little bit more. Lastly, we have risk management. So we continue to always try and adapt to changes because, like we said, the markets can fall irrationally or rationally. And do we have the chance to capitalize on it? Having cash is always a good way of doing it, and I'll cover that later. Okay, so a little bit who I am. I'm the number one most copied in Asia and Australia. I'm currently 5 most copied daily, so this is a bit outdated. I'm currently number 5. I've been working in asset management for about 3 to 4 years. I did investment banking for 3 years. I was a crypto professional for very many years. Trading experience. I tell the story that on my 21st birthday, when it was legal for me to open a trading account, that's actually the day I brought a check to the bank and like, can I open a trading account? That was the exact day. So that's how I celebrated my 21st birthday. Other people get drunk. I opened a trading account. I have a master's degree in finance, bachelor's degree in accounting, a diploma in banking and finance. I have the CISI 3 and 4, and I always say none of it matters. Because managing money in the real world is always a very tough experience, and all the education in the world, all the trading experience may amount to naught if you don't piece it together correctly. And that's what I believe I've done on eToro over the last 10 years. Okay, so I'll hand it over to Bryson to take over the next part.
Thank you, Zech. For those of you who don't know, I am Bryson Riley, equity analyst, and I will be taking you through this portion of the Q3 presentation. Although we have underperformed by approximately 1% in 2024, we have continued to outperform the S&P 500 this year with almost a 10% outperformance as of October 27, 2025. We continue to offer investors meaningful diversification, particularly compared to other PIs that more closely track the index, with a beta of just 0.39, as you can see here. While we have outperformed overall, many of our largest holdings have yet to deliver substantial gains. Smaller positions, such as ACMR, have performed well, whereas DAC, Hogue, and Wallenius have not yet realized their potential. We anticipate performance for these names in the coming quarter. As shown, the Russell Index, representing smaller cap stocks, where we are more active, has underperformed larger cap indices. Once the Russell begins to strengthen, we expect our portfolio to benefit accordingly. Additionally, our cryptocurrency trade in Ethereum has performed well and will be covered in more detail later in the presentation. One of our major positions, Paramount Group, was acquired during the year. This allowed us to realize a 20 to 35% profit on our remaining shares. This marks the second acquisition within our portfolio this year. As Zech mentioned in our previous call, we also saw the acquisition of SOS SAF in France. We believe our disciplined investment approach continues to help us identify these opportunities, providing uncorrelated returns relative to other PIs and traditional investment strategies. Now turning to DAC, one of our largest positions, we can see valuation multiples have continued to contract. However, based on the average remaining charter duration and the current PE ratios, we believe the market is significantly underpricing this stock. Of our two Norwegian positions, we believe the market is overlooking opportunities on smaller exchanges such as Oslo. This allows us to acquire quality companies at very low PE ratios, both on a forward and trailing basis. Given the underinvestment and strict regulation in this market, we believe patience will be rewarded. For our USD positions, we have been executing a carry trade strategy. In brief, this involves earning interest differentials while managing currency exposure. As shown in the screenshots, we have actively traded in and out of USD positions to manage volatility. Currently, we are flat on price but positive on interest income, generating an annualized return of approximately 29 to 34%. We believe this strategy will continue to deliver strong returns as long as we manage the positions carefully. Thank you, and I will pass back over to Zech.
Okay, thanks Bryson for doing that. So it's kind of important that I give Bryson a bit of FaceTime so you know exactly who is managing the portfolio, not some mysterious analyst who lives in Australia. Okay, so moving on. So I see three main risks in the market that kind of concern me. And of course, one we have to talk about is the AI bubble. What is interesting about the AI bubble is people who are not in finance are covering it. And that really scares me because if it's like financial professionals that are talking a little bit about financial markets and, you know, the complexities of it, you know, it's interesting, right? But if like non-finance people are covering it, it makes it seem a bit more risky. A great example of this is one day I knew that crypto was in a bubble was when a taxi driver was trying to pitch me a cryptocurrency, which was weird. But the taxi driver like really has no business looking at crypto, and I was working in crypto at the time. But here he was pitching me a cryptocurrency. So it was a bit of a strange time. So when I see things like this, when retail or regular people are talking about the AI bubble, it scares me. I mean, I love Hank Green. You guys know him. He's got a great YouTube channel. And, you know, of course, Zilla, sorry, I forgot his name suddenly. But yeah, you know, he covers scams and stuff like that. This is his second channel, and you know he's covering as well. So AI is clearly very risky at the moment. So those involved in AI, like Oracle, Meta, Google, obviously OpenAI and stuff like that, these all seem to have, reached a point where it's a bit scary. So our second risk that I see is I've covered this before many, many times. So it's the concept of Michael Green. It's called the systemic risk of passive investing. I covered it on my YouTube channel as well 1 year ago, so quite some time ago. But it's still, obviously, it doesn't pop. We are still facing this issue of passive investing where the biggest companies are getting more capital, and that creates a certain inefficiencies in the market, and it's scary. Just to show you example of like how scary it is, when Michael Green first talked about it is way, way back then. So you can't even see on this chart. But when I put out this like YouTube thing, it was like maybe December, oh, probably a little earlier than that, but sometime last year. And you can see it was, at this 3.36. So what this is the SPY, which is the S&P 500, versus the RSP, which is the equal weight S&P 500. So it shows the difference of how big the top seven are really growing versus the rest of the index. And you can see it's just gone like absolutely parabolic. So the last investor call I said I was worried because we've reached this like all-time high, and now it's just gone even higher. So this is another risk that I see in the market, and it's a little bit scary. So second risk. And of course the third risk is that I see is, are people gonna start withdrawing from their retirement accounts? Because we have more baby boomers kind of leaving the system, so will they start selling down to, fund their retirement? So that's something that's brought up again 7 years ago, so maybe it's old news, but it could be something where the risk is there. We just don't know when it's gonna pop. And if you notice from all three, tend to be risks that are specific to the US. I know there are other risks that we can talk about, such as geopolitical risks, with Trump in the White House, all that tariffs and stuff like that, all that can happen. But these are the three main risks that are kind of, if they hit, they will hit hard, and it scares me. So when we talk about tariffs and there's inflation in the economy, and if something were to happen because of that, the S&P will face these issues, but they will face it even more so because of these three risks that I mentioned. So any kind of shocks to the market, these three will definitely play an even larger impact on the market. So these scare me. The way that we are going to avoid these three risks is, one, cash is great. And I always talk about this like every call. One of the ways that we manage this is really cash. So we also want to stay outside the US, or, as much as possible. Uh, US, and I put Australia in as well. I'm not 100% confident of that because Australia does have very interesting companies, and eToro has been adding to it as well. So it should just be US. In terms of crypto, it's been a little bit strange, I must say. Like, even working in the industry, I find crypto to be one of those things where AI investors and crypto investors more or less overlap. So now that AI has kind of taken over, there's less interest in crypto as they all shifted their attention somewhere else. And that has not been good for the market. As you can see, Bitcoin, as we are recording this video, is now 102. So it's dropped quite a bit from its all-time highs, like 20% down. So it's been an interesting time in crypto. And I got no views on where it's going to go. I'm just going to hold our current position and leave it as that. But yeah, so in terms of cash, before in Feb when the market fell, we deployed as much as we could. We were only 4% cash. Currently we're about 10, and I expect this to be somewhat reduced because some of our positions are going to be wound down. One of these happens to be because of announcement this week, so that's Civitas. Civitas announced that they're going to do a merger, and I'm not too fond of that merger, so I might just risk off and take it off. But we're gonna see how it goes because I normally give these things a little bit of time to play out just to see how the market reacts. So far, market has not reacted great, and I kind of feel the sentiment. So I'm waiting for a little bit more news out of the management team. There is a shareholder voting as well, so those are things that we can wait and look out for. And if those play out, we're gonna start increasing our cash positions. If the market falls, then we, of course, we'll deploy. If the market doesn't fall, we'll just keep our current allocation and make a little bit less on the way up. Okay, and also you can see that from our current portfolio, our beta is very low. So in other words, when the S&P 500 goes up, our exposure to the S&P is not as high as most other portfolios. Some have a very high beta, means that when the S&P goes up, it goes up along with it. So anything above 1 tracks the S&P pretty closely. Like 1.2 would mean it's even more magnified. But what our portfolio shows is that it doesn't really follow the S&P too much. Sometimes the S&P goes up, we go down. Sometimes the S&P goes down, we go up. And that's kind of how we've arranged our bets as well. So you can see here, in terms of sector breakdown, we tend to be very heavy into transportation. Even industrial service and all this is very diversified in terms of sectors. And while I do prefer to keep 8 to 10 bets, we're a little bit more at the moment, I think. In terms of countries, of course, US seems to be the prominent one, but that's for different reasons. For instance, ACM Research, which I presented just now, is seen as a US stock, but it's really based in China. So should you see it as Chinese risk instead? Probably. So that's probably another 5% off. Greece is, of course, Daniels, which is one of our biggest positions. Norway has been extremely interesting recently, and I've got so many ideas out of Norway that I think the country is super undervalued. So I may start deploying more there out of perhaps US and UK, depending on how we go. But yeah, that's all for this update. It's a little bit of a short one, I think. Um, I hope I hit on all the points. If there's any other questions that you guys may have, as always, just post it in the eToro wall and I respond to everybody. So if I miss it, please just tag me in the next post and I'll make sure I respond. Thank you guys so much for your attention.